Everybody has goals for themselves when it comes to 2023, especially with your wealth. Now, whether it's to grow your assets, whether it's to provide more income, or just not to lose money, there are many strategies and techniques you can go down for each one of these different areas. But there's one area that I've been seeing more and more that people are lacking, and this may be you in your overall wealth plan. And that comes back down to good risk management. You see, with all that's going on, having a good risk management strategy is actually going to be very vital for this coming year. As we start talking about risk, it's really important to start looking at the stocks as the very first element here, because that may in doubt be one of the largest amount of risk that you have in your portfolio. You see, when it comes back down to how to be invested, no doubt you've actually done a great job over the years in diversification between different mutual funds, different ETFs, and you've really started to work on making sure that you have the different elements there. Whether it's large companies, small companies, mid-sized companies, value, growth, all of those types of elements. Now that provides the diversification. But what ends up happening is that in this, last year, almost year and a half that we've had this bear market, over the course of the last decade that we've had this massive amount of growth that's happened, things start to get off on the diversification. So much so that you may be what's called overweight in one area and underweight in another area. So you may have an over-concentration to, say, things like large company growth. Well, that could be Amazon or Apple, could be Google, Microsoft, Tesla, Netflix. All of those types of companies are in that category of large company growth tech stocks. Well, you may now have an underweight to other areas. Well, energy had been doing very well. Did you have enough energy in your portfolio at that point in time? It could be utilities or consumer staple funds. All of those are on the other side of the table, more of a value type play. And when we take a look at which ones are in your portfolio, there's chances that you have a lot of overlap starting to creep in. So you may have a lot more of those Apples and Microsoft and Googles in your portfolio just because of the fact that even though you picked different investments to go into, to try to go for that diversification, they may have all been starting to skew towards that one area. So now going back through and taking a look at whether you have large companies, mid-sized, small companies, and sticking to some rules of thumb that we can start looking at, say, having no more than about 6% into certain types of investments. That would really work right there to start reducing the overall risk. Because let's say if large company tech is doing very well, maybe it's the fact that we have others that are not. Well, they can offset and balance each other. And when they are not correlated in this way, meaning that if one's going up while the other's going down, all of a sudden, and this is counterintuitive, you may actually have a higher amount of growth happening in your portfolio with a lower amount of risk. Well, that is, the holy grail of what risk management is all about, but it comes back down to how do we look at the different quadrants that you're in, making sure that you have the correct amount of risk taken for where you want to be, and that we're not unnecessarily heavy and concentrated into one area, because if that area fails, so may your overall portfolio and your then wealth plan. Hey, it's Nathan Krampe, and I create these videos because you are very ambitious when it comes to your overall wealth plan. But right now in 2023, you know that there's a lot of volatility that's out there, and reducing that volatility as part of your portfolio, increasing the returns and reducing the risk is vitally important when it comes to preparing for the future. Now, we have a lot that we're talking about today with respect to how to do just that. So do me a favor, like this video, as well as subscribe to our channel so you can be kept up to date on different elements and ideas as it comes to how to help grow your wealth, how to provide the protection that you need, the diversification that you need, and how to have that work into the advanced planning elements, whether it's wealth enhancement, wealth transfer, wealth protection, or charitable giving. Thanks. Next element that we want to talk about with respect to your risk management comes back down to bonds. You see, there's been a lot of different hardships with bonds over the course of the last year. Same with stocks. And you would think, because of all the different aspects of how you should be working with your portfolio, whether it's a 70-30 split or the gold standard, a 60-40. 60% stocks, 40% bonds, and that's going to provide the protection that you need in your portfolio. That's not the case right now, and that's not been working for the better part of over a year. So what is it about bonds that are providing this just really lackluster performance and actually are a hindrance to your portfolio right now? Well, it comes back to the Federal Reserve, and they have really embarked on an incredibly fast-paced interest rate hiking mechanism to try to get inflation under control. Now, that's not new news, but what is the fact that you're not the only one that's starting to feel the pain with bond prices going down. Banks and a lot of other institutional accounts are doing the same, and they're feeling the pain in the same way. The risk management that they thought they had in place is not there right now. So what do we do about this? Well, as we're taking a look for the rest of 2023, we start to look at where the Federal Reserve has actually said that they are going. Well, right now, we may have either no more rate hikes or maybe 1 to 2 rate hikes left that the Federal Reserve is starting to signal. Well, what that means though is that it's going to be more imperative to take a look at the types of bonds that you have in your accounts. Now, what I mean by this is that if you have an actual bond from the government, so you physically bought a bond from the government, whether it's a very short term, say like 2-year bond, or it's a very long term, like a 30-year bond, if those come down in price because the interest rates change, that's not a problem if you hold it all the way to maturity, because you will be guaranteed to get that money back. So if you paid $1,000 for a bond, you will get the $1,000 back when you hold it to maturity, plus the interest along the way. But if you sell it beforehand, it's going to be whatever value you can sell it for, whether it's below the money you paid or whether it's actually above the money you paid initially. Well, ETFs, mutual funds, are not that way. Those are not guaranteed in the same way that the bonds are from the government. Well, they can be a bond mutual fund, a bond ETF. But here's the thing, the underlying bonds that they buy can be guaranteed, but the stock, the mutual fund, the ETF itself may not be. So knowing which ones we want to be going into at this period of time is going to be much more vital and helpful. So when we come to this type of environment where we have a high interest rate and we may actually be reducing them in the future, this is the time that we actually want to go out into the longer term bonds because they pay a higher interest rate. Now, not only that, we can get the interest rates that are higher than say some of the shorter term ones, but here's the other aspect. They may actually start going up in price. So not only are we going to get the interest and the dividends that they pay out, but we also may start seeing an appreciation, a growth happen. And that may offset losses in stocks or may offset losses in other areas. And again, this comes back down to the correlation that we talk about, where that we want to be going into the diversification. So yes, diversification with stocks and bonds have not been working, but that's one reason and one element we need to keep working on the diversification scale. And to that, we have many other asset classes we can be using as well. Well, speaking of that, there's one asset class that is very controversial that people want to either be avoiding or invested into. Now, I'm not talking about Bitcoin and some of those other very new types of technology investments that people are really starting to invest a lot of their money into, maybe even to the point that they're over-risking some of their wealth. What I am talking about, gold. Now, gold in times of really financial good times, times where we're actually growing in our economy, times that we're actually doing very well with inflation and keeping that low, it's not exactly a great place to be invested. And there's going to be other places like stocks and some bonds that may be a better place to be invested. But when we start to see some financial turmoil start to creep up, when we start to see volatility start to creep up, and when we start to see inflation really start to rear its ugly head, gold does provide an alternative. And that's where we really are finding ourselves now, that stocks are volatile. Bonds actually are very volatile right now, but really gold has not been. And while we have really started to see the fact that it has come up in price recently, that doesn't mean that it's going to all of a sudden turn down and really start to take a nosedive and go down in price. But it also doesn't mean that it has to continue to keep going up either. But what we want the gold to do is offset the risk from some of the other areas. Now, again, when it comes back to diversification, we really can start to see how these different elements start working together. And if we have some stocks in place, we have some bonds in place, and we have some of the gold in place, you can really start to see how if one is not doing as well, some of the others start to pick up and grow and pick up that pace. And that alone is what we look for when we start to increase the returns and lower the risk, all across the fact of the correlation. And gold is not correlated to stocks and bonds the same way other assets are. Commodities are another aspect of the overall wealth plan that may actually not be a part of your assets. Now, again, when we talk about stocks and bonds, those are the general thought process with respect to diversification. Yes, we have gold in there as well, but commodities in and of themselves are something that may produce a really good, offsetting of risk that you don't find and see with other asset classes. Now, yes, we have oil in there, and you don't have to be invested in oil. We have other types of precious metals that are in there, especially industrial metals. So this can be anything from titanium to copper to platinum to palladium. Well, all of those are, needed not only for just building the economy, but also for batteries. Now, when we talk about technology and all of the large companies, especially on the growth front and the technological advances that we're making there, one thing that we're doing some significant advances is coming back down to batteries and how we can be using them in cars, how we can be using them in houses, how we can be using them with wind turbines. All of these different aspects of our society is being changed for the better because of batteries. The mining of them, all the different areas of the different types of precious metals that go into them is something that is a commodity. And those commodities may be a great place to add into your portfolio, again, for diversification. But commodities themselves are very volatile. So when we talk about how much to be invested, this has to be a lot lower piece of the puzzle. We don't want to be invested too heavily into commodities. And a good rule of thumb here is probably on the lines of about 3% of your overall portfolio would be good to have invested into commodities. But what that means to you then is that if we have some stocks, we have some bonds, those can be more of the breadwinner, the larger aspects of your portfolio. We have some gold in there, and gold is something that can be a little bit higher aspect overall. I would say probably no more than 8 to 10% if you're really getting heavily into gold should be what you allocate towards that as part of your portfolio. But then commodities, yes, those are going to be another way to diversify, another way to add a growth element to your portfolio, especially in the times of inflation. Now, those actually may be there, again, to help out in the future, but we also want to make sure, because of the volatility of that sector, that area, we don't want to go too heavily into them. So maybe 3%, but also what it comes back down to, that 3% can still be very helpful in growing and protecting in the times when others aren't. Currencies are another element of risk management that you need to be considering as well. Now, again, like I said, we've been talking a lot about the stocks and bonds and gold and commodities and all these places, but one element that many investment advisors and financial planners don't really add into your plan that actually is a big piece of risk management comes back down to currencies, and more specifically, just having the US dollar, cash, as part of your overall plan. Now, in really good times of growth of the economy, of low inflation, cash is actually, not that helpful because it is not really growing in the same manner. And so it acts as an anchor. But in the times that we have a lot of volatility that are out there, especially with stocks, The times that we have a lot of volatility out there with respect to what we're seeing now with bonds, the US dollar actually has the ability, especially during inflation, to stabilize your portfolio. So again, when we take a look at all these elements, some elements are what we call the defenders, the ones that we don't need them to grow, we just need them not to lose. Where the other ones can be some of our offensive and growth-oriented type of investments. Well, the US dollar is, generally speaking, those defenders, the ones that are used to protect. But in times like now, where we have the volatility, where we have high inflation that's happening, and we have interest rates that are continuing to either rise or be held really consistent without it really going back down, as what the Federal Reserve has been talking to us about, the US dollar has the ability to withstand a lot of the turmoil. And if we're talking about not losing, that's a great place to be. And if we're talking about winning and growing and wanting that growth there, an area that actually has the ability to grow and provide some, well, now good interest to it, still comes back down to the US dollar. So whether it's just investing into an ETF that is backed by the US dollar, whether it is, say, going into other currencies that are actually going up, or whether it's going into a money market account. Having those as part of your portfolio can actually really help to reduce the risk and help to increase the returns. That's the probability of success and how it really works well together, and it's all based upon math. So when we take a look at what's working, something that is providing a high amount of interest, and one that is maybe providing the protection that other elements and areas aren't, that alone is going to help you in the future. There also are many areas that we can be invested into what's called alternatives. Well, alternatives are just a broad category that really is things other than stocks and bonds. So alternatives can be a little bit of anything out there. But for the sake of what we want to be talking about, private equity and real estate. Now, both of those are alternative type of investments, and private equity is such that they're private companies that you can be invested into and invested into the growth of those private companies. They're not the same way as stocks, though, that you can buy with respect to the exchange. So they're not listed on the NASDAQ or the New York Stock Exchange. No, they're private companies, so we have to be invested into them. Well, they can have some great growth, they can have some great ways to give you back some interest and dividends along the way, but here's the thing. Those companies, since they are private, are not liquid the same way that a stock of a publicly traded company is. So yes, they can have some really good aspects of growth, and there's going to be some many times that you want to be invested into them. When the economy is doing well, when inflation is low, those types of investments can do an incredibly good job of growing for your portfolio. In bad times with the economy, in times that we have sticky high inflation, where we have more of a stagnant type of economy, private equity doesn't work as well. And with the valuations today, they may actually be not a great place to be invested. So when we take a look at alternatives, again, this is another place that we only want to be putting a couple percent, maybe 2 or 3% of your hard-earned wealth into those types of companies in the area, because of the fact that there's some volatility to them, and the fact that you can't get your money out all the time when you want it. But there are some great areas to them as well, and one that you should be considering. But the other element with respect to real estate, yes, real estate is known to be an incredible opportunity for growth, and there's many and plenty of, well, millionaires and billionaires that have made their money in real estate. Again, it comes back down to knowing that we shouldn't have too much of your hard-earned wealth in real estate. So of the overall portfolio, yeah, maybe 3, 4, 5% is perfectly fine. Sometimes up to 10%, depending on the types of real estate that you have, could be just fine. They provide differences of interest and dividends that maybe other stocks and bonds don't. They have the ability to grow where others don't as well. But we have to realize that we have had a shock to the real estate system over the last couple of years with COVID. And so when we're taking a look right now at real estate, you have to be aware of the type of real estate you're going into and the ways that you can not only get your money out, but then also what it's going to provide for interest dividends along the way as well. So with that, don't discount private equity, don't discount real estate as part of your overall wealth plan, but make sure that you're looking at the risk associated with that as well. And that's what we're talking about today, all the different elements of risk and how to diversify correctly going forward in 2023. All right, well, we've done a great job of taking a look at all the different elements to look at your portfolio, but there's still one element that I want you to consider. Now, this is something that when we take a look at what is working and what's not, it actually doesn't matter. And what I'm talking about here is adding an annuity into your overall wealth plan. Now, why I suggest this, and again, it's not right for everyone, just like all the different asset classes that I'm talking about is not right for everyone. But it has the ability to reduce your risk and increase your return, just based upon the math behind it. So when we take a look at whether you need to provide some protection so you don't lose, whether you want more income, right now annuities are actually a great place to do both of those elements. And so if we have some money in annuities that are low fees, that are going to be providing some high income for you, well, that's a great place to be looking for. And that can offset the risk that maybe some of your stocks have. And if we go into certain types of annuities that have guarantees to pay out the income, or guarantees that they're not going to lose in volatile times of the stock market, now you can start to see how if we have a little bit there, a little bit into some of those other elements we've been talking about, over the course of time, you're really going to start to see that you have the ability to grow, whether we're in good times of the stock market or like right now, where we're in just a very volatile period of time. And that is what is required of your portfolio. That is what's required of your overall wealth to sustain it for not only today, tomorrow, in the future, for all of retirement, and possibly as you're wanting to leave a legacy. So don't forget to take a look at annuities. And if done correctly, they can be a great place to add an amount of growth, amount of stability, and protection into your plan. I'm glad you've made it this far in the video, and to show you my appreciation, I want to celebrate you. You see, we have a lot that we've talked about with respect to the investments, but what I want to offer you is a special one-on-one consultation. So yes, we will look at those investments, but we're going to go into the other elements of your overall wealth plan. That's the advanced planning, wealth enhancement, wealth transfer, wealth protection, and charitable giving. So we're going to take a look at and make sure that your money is not unjustly taken in the future. We're going to take a look at how to protect yourself just by the nature of the different types of insurances that are out there. We're going to take a look at how to mitigate taxes. And we're going to make sure that we build a charitable piece into your portfolio if it's important to you. So do me a favor, click the link below this video to schedule your one-on-one consultation. You'll be brought to our contact page where you can input your name and your contact information, and there's going to be a message section. And in that message section, put one-on-one. Now what that's going to allow us to do is get in contact with you, and we'll set up that time to meet, and we'll talk through your plan and ways to help improve that plan for not only today, tomorrow, but in the future. With all the different elements to your wealth plan, there are many things you need to be considering. Now I've hand selected this video right here for the next stage and the next element to your overall wealth plan.